The federal government has been steadily arranging for many years to eventually take a significant portion of your retirement savings. Unfortunately, most people only become aware of this fact when they are already dealing with it directly and have very little flexibility left. If you have a 401k or a traditional IRA, there is an existing requirement in federal tax law that can create one of the most powerful and unexpected financial shocks you might face in retirement. This requirement is not a secret in the sense of being deliberately hidden. Instead, it stays out of sight because of its complexity. Buried in dense legal language inside documents almost no one reads closely, and rarely explained in plain terms until important deadlines are near and your choices have already narrowed. This rule is called the required minimum distribution. And understanding exactly how it operates, what has changed recently in the law, why those changes are creating so much confusion right now, and what practical steps you can start taking immediately to protect yourself from its most damaging effects may truly be the single most important financial conversation you have this year. If you have been telling yourself that you will handle this issue at some point in the future or assuming you still have a long time before it matters, now is the time to stop and listen closely because someday tends to arrive much sooner than people expect. Those who delay learning how this rule works are often the ones who pay the highest cost through avoidable taxes and penalties that could have been completely prevented with basic knowledge and reasonable advance planning. The results of being unprepared are not hypothetical. They show up as a specific dollar amount calculated by the IRS and added directly to your tax bill, and that cost grows the longer you wait to act. Let us begin by building a clear foundation because you cannot defend yourself against something you do not fully understand. A required minimum distribution is exactly what the name suggests. It is the smallest amount of money that federal law requires you to withdraw each year from your traditional IRA or 401k once you reach a particular age. This requirement is mandatory. It is not voluntary, not a suggestion, and not a casual guideline with light consequences for ignoring it. It is a firm, legal obligation backed by one of the most severe penalties the IRS imposes on individual taxpayers anywhere in the federal tax code. There is no free pass and no straightforward way to opt out. At some point, withdrawals must begin. To understand why this rule exists, you need to go back to the agreement you entered into when you first started putting money into a traditional retirement account. Every dollar contributed to a traditional IRA or 401k went in before income taxes were taken out. You did not pay income tax on that money when you earned it. Instead, those funds moved straight into your retirement account and immediately began to grow. Over the years, that money compounded with complete protection from current taxation. No tax was due on contributions. No tax was owed on investment gains, and no tax applied to dividends or interest generated inside the account. For a long time, this structure worked very much to your advantage, but it was never intended to last forever, and it was never designed as a permanent gift. The IRS was not being charitable. It was offering a long-term tax deferral. From the start, the law assumed that once you eventually began withdrawals in retirement, every dollar you took out would be taxed as ordinary income. Required minimum distributions exist to make sure eventually does not turn into never. This rule is the government's enforcement tool, setting a defined timeline that compels those deferred taxes to start being paid, regardless of whether you personally need the money at that moment or whether the timing lines up with your financial strategy or retirement goals. In recent years, the landscape has become more confusing, and many Americans are still depending on information that has become outdated. For many years, required minimum distributions started at age 70 and a half, a figure that became deeply embedded in retirement discussions across the country. Later, new legislation shifted the starting age to 72, causing many people to revise their plans. Then the Secure 2.0 Act brought further adjustments, replacing a single universal starting age with rules determined by your year of birth. Under today's law, people born before 1960 must begin required minimum distributions at age 73. Those born in 1960 or later get a bit more time, with distributions beginning at age 75. While that may sound straightforward on its own, the confusion comes from the fact that the rules changed multiple times in a relatively brief period. Many individuals built retirement income plans based on older age requirements and never revisited those strategies to match current law. As a result, they are following timelines that no longer fit their situation. If you are in this category, the mismatch may already be quietly costing you money, or, even worse, putting you at risk of penalties that accurate and updated information could have completely avoided. Here is what happens when timing mistakes occur. If you do not take your required minimum distribution before the yearly deadline, the IRS imposes a penalty equal to 25% of the amount that should have been withdrawn but was not. That number deserves serious attention. 25% is not a minor tweak or a small processing fee that slips unnoticed onto a future tax filing. It represents 25 cents out of every dollar that remains in the account after the deadline has passed. As steep as 25% is, it is actually less than what previous rules allowed. Before recent law changes, failing to take a required minimum distribution triggered a 50% penalty, meaning half of the amount you were required to withdraw could vanish in penalties alone. The drop to 25% is an improvement. Still, it remains one of the toughest financial penalties the IRS charges individual taxpayers. Look at how this plays out with actual figures. Suppose you spent decades practicing steady financial discipline. You saved regularly, stayed committed through market ups and downs, and ultimately built a traditional IRA worth $1 million. That milestone reflects years of effort and consistency. Using the IRS life expectancy tables that determine required minimum distributions, your required withdrawal from an account of that size might be roughly $42,000 in a particular year. If you accidentally fail to take that withdrawal because life got complicated or you misread your starting date, you do not just owe regular income tax on the $42,000. The IRS also adds a penalty of $10,500 on top of your usual tax bill, more than $10,000 charged solely for missing one deadline in a single year. If the mistake continues into additional years without being corrected, penalties stack up quickly, and the financial damage can grow dramatically. The key idea to grasp is that this penalty is completely avoidable. It is not an automatic price of having a retirement account. With good planning and accurate information before your required minimum distribution start date arrives, you can avoid it entirely. Describing the penalty in real dollar terms is not meant to scare you. The purpose is to show the true cost of inaction so that addressing the issue now becomes the obvious choice instead of something you keep pushing into the future. Now let us move the conversation away from the problem and towards solutions, because that is where this topic becomes genuinely useful. Required minimum distributions do not mean you are helpless regarding your financial future. You still have meaningful control and several strategies at your disposal. Smart planning can significantly lessen the tax impact of forced withdrawals and, under favorable conditions, reduce their most harmful effects to almost nothing. Many financial professionals refer to required minimum distributions as a tax bomb, and that term is not an overstatement. It accurately reflects the chain reaction that occurs when forced withdrawals raise your taxable income across multiple parts of your financial life at the same time. Required minimum distributions count as income, whether you actually need the cash or not. If Social Security, pensions, investment income, and other sources already cover your living costs, the required distribution simply becomes extra taxable income you never requested. That additional income boosts your total reported earnings, which may push you into a higher federal tax bracket than you intended. It can also cause a larger share of your Social Security benefits to be taxed, since Social Security taxation is based on a combined income formula. On top of that, it can increase your Medicare Part B and Part D premiums, because Medicare calculates income-related premium surcharges using numbers from previous tax returns. A single required minimum distribution can simultaneously increase income taxes, enlarge the taxable portion of Social Security, and raise Medicare premiums within the same year. This layered effect makes proactive planning crucial. One of the most powerful strategies available before required minimum distributions start is the Roth conversion. The idea is simple, but its long-term impact can transform your retirement outlook. Rather than leaving your entire traditional IRA or 401k untouched until you reach your 70s and forced withdrawals kick in, you deliberately move portions of that money into a Roth IRA beforehand. You pay ordinary income tax on the converted amount. During the year you do the conversion, based on your current tax rate. After the funds enter the Roth IRA, they grow free from federal income tax going forward. Most importantly, Roth IRAs do not require minimum distributions for the original account owner at any age. Every dollar you successfully convert becomes money the government cannot later force you to withdraw according to an IRS schedule, instead of your own needs. Timing is crucial with Roth conversions. Many retirees experience what financial planners call the conversion window. This phase begins once you stop working and ends when required. Minimum distributions must legally start. During this period, your wages are gone, Social Security checks may not yet be coming in, and mandatory withdrawals have not started. Taxable income in these years may be lower than at almost any other stage of your adult life. Making conversions during this window lets you intentionally fill up lower tax brackets, choosing to pay taxes at a lower rate today in order to avoid larger tax bills in the future. Every dollar you convert shrinks the remaining balance that would otherwise generate future required minimum distributions. The sooner you identify this window, the more flexibility you have to use it well. For retirees who already donate to charity, there is another powerful technique called a qualified charitable distribution. Under the right conditions, it can be one of the most tax-efficient tools in retirement planning. Instead of taking your required minimum distribution yourself and listing it as taxable income, you instruct your IRA provider to send the distribution directly to a qualified charity. The money moves directly from your IRA to the charitable organization, never entering your personal bank account or appearing as income on your tax return. Since the funds never count as your personal income, they do not raise your taxable earnings. Yet the IRS still treats your required minimum distribution as fully satisfied. The charity receives the full donation, and your taxable income remains unchanged. Returning to the earlier $42,000 illustration, a regular withdrawal would increase your adjusted gross income, possibly bump you into a higher tax bracket, subject more of your Social Security to taxation, and trigger higher Medicare premiums in the following year. A qualified charitable distribution for the same $42,000 fulfills the legal requirement while adding $0 to your taxable income. For retirees who are already making charitable gifts from their checking or savings accounts, shifting those contributions to come directly from an IRA can deliver immediate tax benefits with no reduction in what the charity receives. To convert these ideas into a clear plan of action, 4 practical steps deserve your attention right now, no matter how distant your required minimum distribution age may feel. First, build a full projection of every expected source of retirement income, including Social Security, pensions, rental income, dividends, interest, and possible part-time work. Establishing this picture before adding required minimum distributions shows how much room you have left in the lower tax brackets. Second, estimate your future required minimum distributions using the IRS calculators or tools your retirement account provider offers. You do not need perfect accuracy. A solid estimate gives you enough detail for effective planning. Third, combine the estimated distribution with your projected income and see how the total lines up with federal tax bracket thresholds. Identify whether these forced withdrawals will raise your taxes, increase how much of your Social Security is taxed, or push your Medicare premiums higher. Fourth, based on what you discover, choose the strategies that best match your circumstances. If your conversion window is still open, explore how Roth conversions can cut down your future tax burden. If you have already started taking distributions and charitable giving reflects your values, look at qualified charitable distributions as a way to meet your obligations without boosting taxable income. Required minimum distributions are not a trivial footnote hidden in retirement paperwork. They form a core feature of traditional retirement accounts and can reshape your income taxes, Social Security taxation, and Medicare premiums all at once if you ignore them. The retirees who handle this stage successfully are the ones who learned the rules before they took effect, acted in advance while several strategies were still on the table, and chose deliberately how and when their retirement savings would be taxed instead of letting default IRS timelines make those decisions for them. The choice is in front of you right now. The most effective time to act is today. For more updates and information like this, follow us Daily Updates.